There are 4 financial projections that I believe every startup needs to have. We'll provide an overview of each of those 4 in today's video. Hi, I'm Steve Morris, and I use this Startup SOS channel to provide practical how-to advice for new entrepreneurs who are building a growth company. What we hope to do today is give you a basic overview of what these 4 statements are and why they're actually important. Now, one caveat, I am not an accountant, not even a finance person, and I'm certainly no expert. I have more of a layperson's understanding of financial statements. You'll certainly at some point want to work with somebody with a stronger accounting background as you develop the statements for your particular startup. So what are the 4 statements? Well, they are the balance sheet, the income statement, changes in cash flow, and then number 4, a simple cash budget. Why do you need these statements? The first 3 are the statements that you'll need to raise money. Whether you're raising money from investors or from a banker, they'll want to look at these 3 financial statements, both what they look like today and what you project them to look like in the next few years. Typically for investors, it'll be a 5-year time frame that they're interested in. So it's fundraising that really is the primary reason you want to do those 3 statements, together with the fact that they provide you some information that helps you track the financial health of your business. Let's start at the top of the list with the balance sheet. What is a balance sheet? Well, basically, it lists 2 kinds of things. On the one hand, assets, things that your company owns, and on the other hand, liabilities and shareholder equity. Now, roughly speaking, the assets are everything from cash to equipment to raw material, everything that your company owns. Those are the assets. Some of them are short-term assets, let's say cash, which obviously can be used very quickly. Some are longer-term assets, like, say, capital equipment. But the assets are essentially those things that you own. Roughly speaking, what the liabilities and shareholder equity is the sources of funding that you had to get those assets that you've got. And it's called a balance sheet because those 2 need to match. The assets that you've obtained have to be equivalent to the liabilities and the shareholder equity, because literally that's the source of the funding that allowed you to purchase those assets, hence the balance sheet. So what are liabilities and shareholders' equity? Well, liabilities, of course, are just basically debt, loans, if you will, money that you owe to someone. When you take out a loan, you get a liability. You're getting, presumably some funding that's going to help you get more assets. But then the other category, this shareholder equity, it really breaks down into 2 pieces. On the one hand, it's investment dollars. That's clearly another source of funding that you can get to buy assets and or pay expenses. That's money from investors, obviously. The other source of funding to pay for those assets are retained earnings. In other words, the money that you've made in doing your business. Now, for an early stage startup, retained earnings are usually negative. So you have to cover those with a combination of investment and debt more often than not. But eventually, retained earnings hopefully become positive as your net income goes positive. And that then becomes, again, a source of funding to pay for additional assets and, of course, for more expenses. So that's the basic idea in the balance sheet. It shows what your assets look like and, again, how you paid for those, your liabilities and your shareholder equity. Next up is the income statement. Now, conceptually, it's pretty straightforward, right? It's the revenue that you earn by selling a product or a service and the expenses that you incur in selling those products and services. And the difference between the 2, of course, would be your net income. So that seems pretty straightforward at first blush. It seems straightforward, but they get a little more complicated because of a thing called accruals. A little background on accruals. When you do your accounting for your company, you'll either use a cash approach or an accrual approach. Odds are very good that your accountant will really want you to use an accrual approach, and it's what typically an investor will expect. Now, what exactly is the difference between the 2? Well, let's start with cash. If you use cash-based accounting, then you simply are following the actual cash. You recognize revenue when you get cash in the door. You cash a check from a customer, or you receive money through a credit card transaction. You recognize that revenue when you actually receive the cash. And likewise for expenses, you recognize the expense when literally the cash goes out the door. Now, that all makes pretty intuitive sense and kind of feels like the way it should be. However, a cash-based accounting, in a way, doesn't really necessarily reflect an accurate picture of the business, in that it doesn't really show revenue as when you earned it. It shows revenue as when the customer paid for it. Now, the customer might pay up front, or they might pay 2-3 months down the road after they get your product, depending on the terms. So cash doesn't necessarily accurately reflect the financial situation of your business. And that's where accrual accounting comes in. Accrual accounting really separates out the idea of revenue and expense from when the cash actually comes and goes. Instead, accrual accounting seeks to recognize revenue when it's been earned, and likewise to recognize expenses when they've been incurred. So what does that really mean? For revenue accrual, just a couple of examples. Let's say your product is some type of capital equipment. Well, it depends on exactly what your terms are, but very commonly what happens is you will recognize revenue for a sale of capital equipment when it literally ships, when it leaves your dock, is a very common way to do it. Now, you might not get paid for that capital equipment for 30 or 60 or even more days down the road. But for your financial statement, say for your income statement, you will recognize that revenue when the capital equipment actually shifts, because in a sense, that's when you've earned it. You've shipped the product to the customer, so you have earned their payment. Another example, an annual subscription. Let's say that's your business model. You're a software as a service company, and let's say you receive an annual subscription payment from a customer. Well, that cash may all come in up front in, let's say, January 1, but on your income statement, you're probably, if you're using accruals at least, probably not going to recognize all of that as revenue. The cash came in the door, but in a sense, you're earning that annual subscription 1 month at a time as you deliver the service you're delivering. So from an accrual point of view, typically what you'll do is you'll recognize 1/12 of that total revenue each month. And again, the idea is that makes your revenue more accurately reflect when you're earning the revenue, because you're earning it 1 month at a time as you deliver your service. What actually happens on your financial statements when you're doing an annual subscription using accruals? Well, let's say in January 1, let's say you get paid $12,000 for an annual subscription. Well, that money actually goes into an account called deferred revenue on your balance sheet, and it is a liability. It's a liability because it reflects something that you haven't earned yet. Until you earn it, it's going to stay as a liability. Now, that liability item on the balance sheet is balanced by the fact that you're increasing your cash, right? So cash went up when you deposited the check, but you have this liability that got created, hence your balance sheet balances. Now, at the end of the month, you've earned, presumably, if all goes well, 1/12 of that $12,000. You've delivered the service for 1 month. And so you will recognize for the month of January $1,000 in revenue on your income statement. And on your balance sheet at the end of the month, that deferred revenue will go down, reflecting the fact that there's that much less liability because you've delivered 1/12 of the service that you committed to deliver for the annual payment. Accrual accounting seeks to recognize expenses when they've been incurred. So what does that really mean? Let's say you buy a bunch of raw material that's going to go into a product that you're making. That raw material that's part of the product will probably count as COGS, cost of goods sold. So that's incorporated into the product. and it's recognized as a cost that gets subtracted from revenue on your income statement, which is to say it gets taken into account when you ship the product, when you're recognizing the revenue. Because again, the expense of that raw material is associated with the delivery of the product that the material went in. So you're, in a sense, incurring that expense when you receive or earn the revenue for the product. Now, you might have paid for that raw material a month or two earlier. So the cash was a totally separate transaction from when you're recognizing that as an expense. Another interesting type of expense, of course, is depreciation. Now, depreciation is simply where you show a decrease in value of a capital asset to try to accurately represent how it's being used up or becoming less and less valuable, more obsolete over time, and eventually will reach zero value, and perhaps then it's time to replace it. But depreciation is sort of a made-up expense. It's not as if you're writing a check each month to pay for your depreciation. It's something that reflects the idea that you're sort of using up or seeing a decline in value of your asset. And yet, depreciation appears as an expense on your income statement. So unlike the cost accounting example, depreciation is something that is completely divorced from cash. It reflects an expense that reduces your profit, but there's really no cash at all changing hands to reflect depreciation as sort of a real expense. Those are just some examples of when you get into an accrual world, how your life really is fundamentally different than a cash-based business. So yes, conceptually, an income statement is just showing your revenue and your expenses. The trick is figuring out when revenue is recognized and when those expenses are recognized, so you know how to deal with them, how to really project them in the income statement. Finally, that brings us to the cash flow or changes in cash flow statement. The idea with the cash flow statement is for whatever the period is you're looking at, whether it's 1 month or 1 quarter or 1 year, you're looking at the beginning cash at the beginning of that period. And what you want to do is project, I'm talking projections as opposed to historic statements, you want to project what your ending cash is going to be at the end of that period. Well, in an accrual world, the way you do that is you start with your net income. Now, net income, again, roughly speaking, is revenue minus expenses. So it sort of reflects the money that you've made. Clearly, if you make money, you get more revenue than your expenses, then your cash is going to go up. So starting with beginning cash, you add in your net income. But then you also add in your depreciation. Because remember, depreciation is sort of a made-up expense that serves a purpose, but it's not real cash, and yet you subtracted it from the net income. So you're going to add that back because you didn't actually use any money in paying that depreciation expense. Likewise, you're going to subtract any changes in assets, because if you purchased assets, so your assets went up, then your cash presumably is going down because you paid for those assets. Likewise, you'll subtract any changes in property and equipment, the more capital level of purchases, for the same reason. Then you'll add in any funding that you obtained through borrowing, through increasing your debt, and you'll add in any additional funds that you got from stock sales, from, say, investment by investors. And adding all of that up then finally gives you the projection of what your ending cash is. So you can see accruals make it conceptually a little bit more complicated than a simple cash basis. You have to sort of back into the cash when you start from net income, which is, again, based on accruals. That's a very quick overview of the balance sheet, the income statement, and the changes in cash flow. So the fourth statement I'd suggest any startup have, especially when you're very early on before you have a finance person really tracking your cash, is to have a simple cash budget. Because the one critical thing you have to do is make sure that your cash does not go to zero. Typically, if it goes to zero, it is game over. So a simple cash budget is a good idea to something to maintain. And basically what that is leveraging is your knowledge of exactly when cash is going to be coming in the door. Like when current existing customers are going to pay you, when a bank loan is going to come through, when some investor dollars are going to come through, when exactly is money going to go into the checking account. And on the other hand, when exactly does it have to go out, and how much goes out to pay for raw material, to pay for rent, to pay for salaries, to pay for whatever you have to pay for. And of course, you don't want to look at that in a long-term time frame. You want to look at it on a daily basis, because the goal here is to never have your checking account go to zero. So again, when you're early on and you don't have a finance person who's keeping track of your cash on a regular basis, it's a very good idea to have, for the CEO to have, that kind of a cash-based budget where they keep track of cash every day. Because again, you don't want to run out. So that's really a separate beast from, say, the changes in cash flow statement. Changes in cash flow, as we talked about, you're typically backing into that from your revenue statement. That's a lot of layers of assumptions and accruals and complexity to get through. To really keep track of cash, it's safer early on, when frankly your finances are relatively simple, to simply focus on what you know about when customer X is going to pay, when that money will hit your checking account, when that bank loan will come through, when that investor check will come through, and likewise, when do you have to write all those various checks that you have to write. So you can track cash when you're early on, and your number of transactions isn't that great, and it's an important thing to do to make darn sure your cash doesn't go to zero. So cash budget, that's the fourth statement that I'd strongly suggest all early stage startups maintain. So those are the four critical statements: balance sheet, income statement, changes in cash flow, and a simple cash-based budget. As I suggested earlier, you'll need, for investors and bankers, projections of the first three. And that's always a challenge when you're early on in the startup life, is you have no history, no revenue track record, no expense track record. How do you come up with a 5-year financial projection? It's not easy. Well, it typically needs to start with the income statement. If you can do that, then you can derive a balance sheet and a changes in cash flow from that. But okay, great. How do you project your income statement? In later videos in this series, we'll go through some ideas as to how to tackle that challenge. How can you actually do projections of especially the first three statements when you're an early stage startup with very little history? So that's a quick overview of those four financial projections. Again, more details to come in follow-on videos. If this was helpful, please click the like button and share it with other entrepreneurs. Leave a comment if you have any feedback or questions. And if you haven't subscribed yet, please do that and hit that bell for the reminders to make sure you don't miss any of the future videos. And of course, this will be part of a series of videos. There's a link right here to the playlist for the series, which we'll keep adding to over the next few weeks. That's a wrap for now. Thank you very much for watching.